Welcome back, traders and investors, to Benzinga's pre-market prep, brought to you by MarketFi. I'm your co-host Joel Alconin, along with Brianna Valesky, and we have Mark Yusko on the line. He's the CEO and CIO of Morgan Creek Capital Management. Mark, how you doing this morning?
Doing great. Thanks for having me back.
Okay, before we kick things off, I just got to get your quick take here on the big news with General Electric today, trading sharply higher off the news that they're doing a big buyback, and we were debating whether or not a big buyback or actually a $5 special dividend would it perhaps behoove shareholders more. Do you have any take on that?
Yeah, well, I have a lot of takes on this. I'm actually in the camp that I borrowed from James Montier up at GMO in Boston, who says that this concept of SVM, shareholder value maximization, is a big sham, and that this whole issuing debt to buy back stock is not a great thing long term. It's really good for management teams in the short term, but shareholders are not going to benefit long term. So I'm actually not a big fan of it. I'm not sure I like special dividends either, because the company, what I really rather have the company do is invest. And I think the big challenge for investors from here is, the buyback game, I think, is just about over. Not today, notwithstanding, but I think it's going to be very difficult for companies to earn greater profits if they don't start investing. And I think you're going to see that in first quarter earnings. First quarter earnings probably going to be negative this year. So
Okay.
not a good sign.
Yeah, let's talk about that. What are you expecting out of Q1 earnings? I mean, many are saying that might come in a little bit light. Who knows? We could always blame the weather. What are you looking for here in Q1?
Well, they'll definitely blame the weather, and they'll blame the weather for the miss in Q1 GDP, which is probably going to come in, close to zero. I don't think it'll actually go negative this year like last year, but it'll be sub 1% would be my guess. They'll blame the weather for that. Interesting stat, we actually had more heating days this winter than we did last winter. Last winter was the polar vortex, so I guess this was polar vortex 2.0. So it was pretty cold out there. I think earnings are going to be light in a lot of areas. I think they're going to be very strong, though, in a couple areas. Airlines, for example, I think are going to crush earnings. A lot of that's just because their biggest cost, the cost of fuel, is down, over 50%. So there are going to be some good surprises, and I think the other problem is any company that had big exposure to foreign sales, we saw that yesterday with Alcoa, is going to get smacked a little bit. So I think there are going to be a lot of earnings disappointments.
Okay, you mentioned airlines is the winners based on the lower fuel cost. Any other sectors you're looking to be winners here?
I think domestically oriented companies will do well as well. So people who don't have a lot of foreign sales, companies that are really focused on U.S. consumer, I think will have some positive surprises. One of the best stocks really since 1968. I'm not quite sure why they picked that date to start this study, but that was what I saw was Philip Morris and Altria. I mean, selling cigarettes is a very, very profitable, good long-term business, countercyclical, all kinds of great things about it. It's going to probably have a blowout quarter from a concept I talk about called little luxuries, which is, gas prices went down, and they didn't go down enough for people to rush out and buy a diamond from Tiffany's, but they did go down enough that you got $10 in your pocket at the gas station. You go to the mini mart and you buy extra beer, you buy more cigarettes, you buy more Twinkies, you go out to dinner at Applebee's or one of the casual dining restaurants. So casual dining like Darden and some of the others, I think will have positive earnings, and I think anything related to stuff you can buy at the mini mart will actually do well too.
Okay, and you talk about some of the winners, some of the losers here, the lingering effects of the strong dollar. Who are some of the losers here? You think some of these multinational corporations that have exposure overseas will be your losers? Maybe some of your Procter and Gamble, something like that.
For sure, for sure. Anyone who is, a global company but happens to be domiciled in the United States, It's going to be very tough. Some of the big tech companies that have a lot of sales overseas, their earnings are going to be quite light. I think we got a little preview of that last quarter with Microsoft. I think they could be in for some trouble. I think the PC market, anything related to PCs, is probably going to struggle here with earnings as well, because a lot of those sales were overseas, and there's just been this rapid decline as people switch from PCs to smartphones. But multinationals for sure, I think, are going to struggle. The other sector that's going to struggle is commodities. Commodity companies based here are really in trouble because their costs are rising and their revenues are falling with the currency problem. Now, that's actually a positive. So here we're talking about all these U.S. companies. You flip this around, it's hugely positive for companies like in places like Russia and Brazil, where the currency has just collapsed, and so their costs are falling, and they sell in the global marketplace. So steel companies in Russia and Brazil have been surging. You got companies like Japan, or countries like Japan, where earnings are going to set all-time records this quarter. So you flip the story completely on its head when you go outside the United States.
And just do you pay much attention to Wall Street and the analysts? We got a couple downgrades over Apple over the last 2 days here, and not sure. I mean, they do just some sales overseas, pretty much a domestic company, though. What are your thoughts on Apple?
So to answer the first part of your question is I actually don't pay much attention to analysts on Wall Street. I actually pay the opposite of attention.
Okay.
So whatever they say, I want to do the opposite. And that's not just because they're on average only right 40% of the time, which is a frightening stat, but it's mostly because their incentives are wrong. There's no incentive if you're a Wall Street analyst to ever say anything negative because you don't get paid for that. So I just think that so one might argue that if they actually do a downgrade, then it really means something, and I think there's some information content there. I think with Apple, the problem is no one has a clue. People have been so wrong on Apple for so long, by orders of magnitude. I mean, there was nobody that thought that they were going to make $18 billion of profits last quarter. One quarter, right? They made more money in a quarter than 435 of the 500 companies in the S&P did in the previous 5 years. Let that sink in for a second. One company did better than 435 companies in one quarter versus 5 years. So I think people will miss Apple again. I think if you look around anecdotally, everyone in the world today is buying iPhones and iPads and phablets and whatever. I've got the iPhone 6 Plus and I love it, and I would never give it up now that I've gone big. So I was on a plane the other day on Southwest, right? Not even in first class of one of the big guys, but that across the whole multitude of people, everybody had an iPhone or an iPad on that flight. It was unbelievable. Everyone was staring at the screen. So not sure that the downgrade isn't a good idea because it has run pretty hard over the last year, but I do think most people don't understand how big Apple is. And there's a company I love in China called Xiaomi that is, I think, the next Apple. I think they're gonna become one of the greatest phone sellers in the world, but even they slipped to number 2 behind Apple this quarter in total sales. And China favors their national champions, so they give an edge to local brands. And Apple is so good a product that it's making inroads there. So it's a pretty interesting company.
Yeah, definitely hard to bet against it here. So, also, looking forward here, Q1 earnings here. Are there any stocks that have kind of, have sold off over the last quarter here? Maybe they've, lowered guidance or lowered expectations, and you think that that maybe the street's kind of overdone it a little bit, because a lot of times you see stocks rally when they beat lowered expectations.
Sure. Well, it's great. It's a great game, right? If a year ago you tell people you're going to make 10 cents, and then this quarter you tell people you're going to make a penny, and you come in at 2 pennies, and everybody says, "Oh, it's 100% surprise." Like, are you kidding me? That's down 80% if you ask me. So I think that game is played very, very effectively, and I think unfortunately people pay attention to it. And every quarter, we have 66, 67% of companies, quote unquote, beat expectations. But when you look at the squiggles, what are called earnings squiggles, which track the earnings estimates over the previous 18 months, they're all incredibly downward sloping. So that's not a good thing. But I think there will be plenty of examples of that where people have lowered guidance so much and the comps are so bad. Gaming is one of those places. Gaming, everybody is worried about gaming because of the crackdown on corruption in China and people spending less but the comps, because of the polar vortex last year in first quarter in the U.S., people couldn't get to Vegas. So I think there were some places where the year-over-year comps could be pretty good, and there'll be a surprise. So I think that's one where sentiment is pretty negative. Even the slightest little surprise could be positive, and things could do well there. I do think that in the commodity space, people have slashed their forecast pretty hard. People are aware of CapEx budgets shrinking, so there could be some accounting creativity, shall we say?
Okay.
Where they pull some of the. GE used to be, back to the GE point. GE used to be famous about this. Is they had all these subsidiaries, and so there was always something that was doing well, and they could always find an extra couple pennies to beat earnings every quarter. So the one thing you got to watch is when a company finally does miss and doesn't beat, that means they've run out of stuff in the cupboard. So it usually is what's called serially autocorrelated, meaning if you beat one quarter, you're likely to beat the next quarter and the next and the next. But once you miss, you're likely to miss the next and the next and the next. So they tend to follow a pattern like that.
And any ones that any issues that have been flying high off a good Q4 beat, momentum has it going strong. Maybe something like a Twitter. Of course, you got a little bit of takeover rumors and that earlier in the week.
Oh yeah.
Yeah. Is there anything that might be ripe for a stumble?
Well, sure. All kinds of things. Look at China, for example, in the last couple weeks or last couple days even. A shares and H shares, up 5, 6, 7% a day. A shares is a good example. Over the last year, A shares are up 100%. From a pretty depressed state. Now, I think long term, A shares are a buy. I think China's a buy long term, but I think in the short run, there are going to be some people that disappoint. And I think that you could see some pretty big pullbacks. Some of the China internet technology stocks that are listed here in the United States, a company that we love, absolutely love, VIP Shop, VIPS, it's up 60% year to date. So yeah, I think that could not be quite as good as people expect, or it won't beat by as much as people are hoping in first quarter, and it could stumble a little bit here, but it'll go up more after that because it's a fantastic long-term story.
So you're not tempted to take profits in something like this after this kind of moves, or just holding out long term?
It's always prudent when you have a 50 or 60% move in 3 months. I believe it's always prudent to take some profits, and you don't go to zero if you believe in the long-term story, but it's always prudent to take a little bit of profits and redeploy into something else. So I could easily take money from something like that and redeploy into a place like Brazil, which is at maximum pessimism. Everybody hates Brazil. And you look at something like Petrobras, which less than 6 months ago was $20. It hit $5 a couple weeks ago. Now it's back to $7.50. So you say, oh my gosh, it's up too much. It's up 50% in a couple weeks. Yeah, but it's down a lot. And people were afraid it was going to go not out of business, but they were afraid the equity was going to be worthless because of the big scandal. But there are lots of places that you can trim some profits and redeploy into things that are down a lot and look better long term. The one place I would be careful is energy. A lot of people think energy has bottomed, oil prices have bottomed. We don't think so. We think oil is going to be lower for longer. and earnings are not going to be as good as people think. And these big moves that people saw in the first quarter in some of the energy producers are going to be very disappointing for people. So I might take some profits there too.
Okay, so if you have any. So you manage $4.1 billion in assets. Okay, I don't know how
Right?
I don't know how you sleep at night, but
No. Stay diversified and hedged. That's how we sleep
okay,
at
there
night.
you go. That's what I was just going to ask you about hedged. How do you hedge $4.1 billion? I mean, I know it's not all on one account and one thing, but
Exactly.
do
Yeah.
you are you more prone to sell calls and for stocks that you have a nice profit in and you have a profit target above that? Do you try and buy puts and just pay the premium gods? Do you try and use the futures markets at all? How do you hedge that $4.1
Yep. So
billion
two
dollars?
things that are important. One is half of that money is in the private markets,
Ooh,
so there's a natural hedge there, and half is in the public markets.
okay,
But in the public markets, most of what we do is in hedged strategies. So, and I intentionally add the D on because most people talk about hedge funds without the D, but I like to talk about hedged funds where people actually do hedge. So, I was with a manager here right before we got on the call, and they do long short real estate. And so, one way is you pair trade. So he's a big pair trader. So he'll buy, an area like, public storage. He'll buy the smaller companies and he'll short the larger companies against it because he thinks, the larger companies are selling at a premium because everybody is desperate for yield. So I think that's an interesting trade. Or we'll invest with people who, will think more of hedging as tactical, meaning they'll look for things that have done really, really well, like technology, and they may sell some of those securities short. We don't play much in the options market, although I think it's a perfectly viable strategy, but that's just not an area we've spent a lot of time in over the years. We do traffic in the futures market and the index market. So, when we want to take down exposure, for example, in what we call our opportunity fund, which is a long short fund that we manage, we got nervous about, or are getting nervous, increasingly nervous about valuations in the U.S. So, but we love our core holdings, so we didn't want to sell those. So we actually will then use these leveraged ETFs to go short on against that basket. So we don't have to disrupt our long holdings, but we take the market risk out and try to concentrate on the alpha.
We got an interesting comment in our chat here earlier, and this is just going back to the GE discussion. And, he noticed that the REITs kind of took a hit yesterday. And do you think by, what GE is doing here, they're, maybe seeing a little bit of softening in that, in the REIT market? I don't know, related to interest rates or not, and just trying to, limit their exposure?
Well, I mean, the GE transaction is very complicated. It's very unique, and I think it's a function of the fact that there's just a massive amount of capital globally that's trying to get into, domestic real estate, U.S. real estate. And so Blackstone, right, which has got most of their money now coming from these big sovereign wealth funds and giant pension funds around the world, they're willing to put capital in these core plus assets, they didn't used to do that, right? They used to be more of an opportunistic or upper value added play and searching for 20+% returns. And with cap rates where they are today and interest rates where they are today, people are looking at their fixed income portfolios, these big institutional investors, and they see 3 and 4% yields being better than 0 to 1% yields or negative yields if they're in Europe. So I think it's a loser's game long term, but I understand why these big pension funds are doing it because they have to invest the money somewhere, and core real estate's better than fixed income from here. And I also understand why GE's doing it because they kind of bought at the peak, They unfortunately did exactly the wrong thing. They bought huge amounts of assets at the peak in '07. They suffered through the impairment. They've kind of gotten now back to where they don't have to take a big hit to get rid of these assets, and they can sell assets that don't sell at a huge PE multiple, and concentrate that money back in the business where you do get a bigger PE multiple, manufacturing, and they can buy back stock, which further concentrates. So it's actually a win-win-win, if you can believe that. There aren't many of those out on the street, but this actually is a win-win-win for everybody.
Okay, we've been on the line with Mark Yusko. He is CEO and CIO of Morgan Creek Capital Management. Thanks for joining us, Mark. Great insight on the markets, and we hope to speak to you again.
Thanks for having me. Talk to you guys soon.